3 steps is all you need to get these type of high win rate setups. As the first step, we begin with a directional analysis of the price action. Basically, we want to know the swing points and the trend, which in this price action when we see that we have an upside movement that is then followed with a downside pullback, and that pullback is then followed with another upside push, and this upside push breaks above the last high. This price pattern is indicative of a market following an uptrend. So now that we got the first step, we get into the second step. The second step is about finding an entry structure based on the trend the market is following. And since we know that this is an uptrend, on uptrends we need to identify demand zones. And they are found on the last low before the market broke to the upside. And we will often notice that the price will fall down into this demand. Moment where we get into the third and last step, which is the planning of the setup, we will look to plan a buy setup from the demand with the stop loss below the demand and take profit above the last high, expecting a break of the last high, since that's what actually happens on uptrends. Now eventually the market will break down below the last low, even if the market is following an uptrend, and it's important that we see it. It's what we do on the first step, which is analyzing the direction of the price action. And when the last low breaks down, the trend changes from an uptrend into a downtrend. That's when we get into the second step, which is finding an entry structure based on the trend the market is following. On downtrends, we no longer identify demand zones, but now we identify supply zones, which they are found on the last high before the market broke the last low. The market will often pull back into these supply zones, moment where we get into the third step, and that is the planning of the setup. We will be looking to plan sell setups from supply zones with the stop loss above the last high and take profit below the last low in an expectation of the last low to break down, because that's what happens on downtrends. Now if we come back into the chart and we apply the first step, which is to analyze the direction of the price action. And what we have so far is a market that looks like it's been following an uptrend. We know that because we have a swing high that broke to the upside, so the market leaves the break of structure on the highs, meaning that if highs constantly break, that means we're having higher highs, which are swing points that are seen on uptrends. Now that we know that this market is following an uptrend, we move into the second step. The second step is about finding an entry structure based on the trend the market is following. Now, since we're following an uptrend, on uptrends it's demand zones that act as support levels, so we identify the demand, which as you've seen on the early presentation, demand levels are found on the lows right before the market started to push to the upside, before the break of structure itself. And we're seeing how the market is right now getting close to hit the demand. If it does hit, we will be expecting a bounce from this demand so the market can continue the uptrend. And uptrend continuation happens if the market keeps respecting a higher high formation, so basically we want the last high to break to the upside. And now that we know the direction, and we also identified the entry structure, we get into the last step. The last step is the planning of the setup, which in this specific case, the planning of the setup would be a buy long position from the top of the demand, stop loss below, and take profit above the last high, since we're expecting this last high to break, which, as I said, it's what it happens on uptrends. The price falls down and hits into the demand, opening the buy position, and also notice how right after hitting the demand, the very next candle prints a bullish reaction. This shows that buyers are starting to pressure the price into higher levels. This upside pressure kept going for a while until eventually the market hits on the take profit target, closing the position on a win. Now we could leave the charts and come back on another day where we restart the analysis step by step, just like we've done on this market. Or we can continue the analysis and see if there are more opportunities. For example, we don't only care about the fact that this position has hit the take profit, but we also care that in order for this take profit to be hit, the market must have broken above the last high, since that's where we place the take profit for this setup. And that means that we got a higher high, which is a swing point of an uptrend, and after a higher low should often be the next swing point, as long as the uptrend keeps holding. And a higher low is seen as a downside pullback where, as you know by its name, a higher low needs to end higher than the last low. The level it usually ends is inside of a demand zone that acts as a support. The demand is taken from the previous low, and more specifically, it's near the last candle that pushed down right before the price started the upside impulse. Now we see that in this example, the market kept pushing higher, formed a similar structure of a downside pullback followed with an upside push that breaks above the last high. However, the market left this demand behind. Does it mean it will never come back again to this demand? The market can still pull into this demand, but until that, we can follow the momentum and direction the market is forming. For example, this structure left another demand from the last low, and we can now trade this recently formed demand with the same logical placements of the stop loss, which is below the demand, and take profit above the last high, for an expectation of the previous high to break to the upside, which is basically just an uptrend continuation. And until we have a reversal, there is no point in being bearish or planning anything else. Now coming back to the position, since it's already opened right here, we now wait and see what target hits first. And looks like it continues higher into the take profit level. The market pulled down into the demand and bounced to the upside into breaking the last high, which is exactly like we've seen on the theory presentation. When we have this pattern of a downside pullback that is then followed with an upside push that breaks above the last high, this might leave a demand zone taken from the last low, which is also the low that filled the previous demand. And this creates a new demand since it's the last low before the market started the upside push, and we see the price falling down right now and getting very close into filling this new demand. Since it's really close, we can already plan a buy setup from the demand, stop loss below the demand, take profit above the last high. We're targeting at least a 1-to-2 risk-reward ratio. The demand fills, which opens the buy setup, and we also see that it's getting really close to hitting the stop loss. So we need to be careful of these situations. But as long as the last low and the demand doesn't break, we're still fine and the market is still following an uptrend. As we also see that it eventually bounced to the upside from the demand, and then also broke above the last high, which is a sign that this upside action should still keep going for some more time. Now it pulls back to the downside, but still ended above the last low before the price again started to continue the upside pressure. And this keeps going until eventually it closes the setup on the take profit. And if we check the price action the market has been forming, which was the price action that led into the setup to be closing on a win, we see that it basically kept the same pattern of a downside pullback, which filled this demand, followed with a bullish reaction that bounced from the demand and broke above the last high. And when the last high breaks, the market should leave another demand from the last low. Demand that has already respected if we look at it, because we have the price that pulled back down into this demand and bounced to the upside from it, breaking above the last high. So this could have been another great planning for a buy setup. We just skipped it because we were already on another position and we don't want to open multiple positions at the same time, but that was just to show you that you can find multiple opportunities. It's not only one demand that will work out, there are more. We just need to make sure to find them, and most importantly, we need to make sure the trends support them, because remember, demand levels are validated only on uptrends. The uptrend is held as long as the market keeps forming these higher low and higher high formations, and the demand is always found on the last low before the market started the upside impulse that caused a break of structure to the upside. So we identify that demand. The new demand should be around this level, which is the last downside movement before the market started to go up, and we expect a similar pattern just like it is done here on the other demand zones from the left. So we expect a pullback to the downside that should fill this demand, and from that level we will be looking for a buy-long setup to take the market into uptrend continuation, which is above the last high, basically breaking the last high and creating a new high, which needs to be higher than the last one. So essentially it must be a higher high formation. So we plan the buy setup with the stop loss below the demand and take profit above the last high. Price falls into the demand, opening the buy position. But this time the demand breaks down, which means that the setup ends on the first stop loss getting hit. So if the demand broke down, that also means that the previous low also broke to the downside. And when the last low breaks down while the market was in an uptrend, that first downside break shows that this market might be reversing into a downtrend. It's why we call the first break of the previous low as a change of character, trend change, or market structure shift, because it shifts the trend and price action from an uptrend pattern into a downtrend pattern. And on a downtrend, demand zones will no longer validate, so there's no point in looking for demand levels, but instead now we look for supply zones as they act as resistance levels. We find these supply zones on this descending price action. So we start again with the first step, analyzing the direction of the price action, where we can see that we start with a push to the downside that was followed with an upside pullback that faded down into breaking the last low. So we take a look at the swing points. We're starting to have lower highs coupled with lower lows, so the breaks are now on the lows. And after a break, we identify a supply. The supply is found on the last high before the break, more exactly on the last upside movement before the market started the downside pressure. Around this level, this being a supply, and supplies act as resistance levels, meaning that price will often fill into these levels and reject back down from them. The point is that we take advantage of this downside rejection with a sell short setup from the supply, the stop loss above the high, and take profit below the low in an expectation of the last low to break down, which is exactly what it did. Now that you also know how this would work if the market would follow a downtrend, let's start from scratch on another market. So we start with the first step, and that's analyzing the direction of the price action. And we're going to see a downtrend formation. So if the low breaks down, that means that we validate supply zones, and supply zones are found on the previous high before the market started the downside impulse. And we're going to see that it's exactly on this supply where the next upside pullback has ended. We see it right here. It's right after the market pulled back into this supply the moment it also topped and started to push down, and this downside movement breaks below the previous low. So if the past low broke down, that means that we can now look for another supply from the last high before the market started the downside impulse. And that should be around this candle. And we also see that in this case as well, the market pulled back into this supply, and it's exactly where it topped. It's exactly the moment the market started to push down again. So we know that the way to take advantage of these supply zones is to plan a sell short setup from them, with the stop loss above the supply, and take profit below the last low, since we expect a lower low formation, basically for the last low to break down, similar to what it also did before. And after the past low breaks down, we can then look for another supply from the previous high, supply that should be found on the last upside movement before the market started the downside impulse, around this level. Now we can plan a sell setup from this supply with the stop loss above the supply and take profit below the last low, again in an expectation for the last low to break to the downside. The market pulls back to the upside, filled the supply and opened the sell setup. Then it quickly starts dropping, pulling back up again. And eventually we get this massive drop that breaks below the last low, which means that the position closes on the take profit. It might take you some time to properly learn this strategy. The only more complex part that you really should understand well is the directional analysis. If you master that, you will notice how smooth this strategy becomes. And if you're interested for more, you might take a look at our program linked in the description, where we focus not on winning, but most importantly on keeping the wins and not losing them back.